Welcome back to the Deep Dive. Today, we are taking on a subject that, frankly, scares a lot of people away. Accounting.
It does. People hear the word and they tune out.
Right. We're taught to see it as this, monolithic block of compliance and complexity, a necessary evil.
Mm-hmm.
But our source material completely reframes this. It clarifies that when people talk about accounting, they're actually mixing up two fundamentally different disciplines.
That's the key insight. They're designed for two totally separate ecosystems.
And getting this distinction right isn't just, academic. It's the difference between actually running a successful business and just complying with the law.
Exactly.
To set the stage, let's use the core analogy from our sources. It's brilliant. There's financial accounting, which is the final scoreboard.
The official record.
The official, standardized record of the game, shared publicly with everyone, the fans, the bettors, the league.
Right.
But then there's management accounting. And that is the detailed, secret playbook.
Strictly for the team, the coach, the players, the people trying to actually win the game.
Precisely. And our mission in this deep dive is to use the source material to give you a definitive framework.
We're going to separate these two worlds across 7 crucial dimensions. We want to move past just definitions and get into the strategic implications.
So by the end of this conversation, you'll understand exactly why the sources call them different species growing in different ecosystems.
That's the goal.
Okay, let's unpack this. Let's start with the most obvious difference. Who is all this information for, and what motivates its creation in the first place?
Right. The audience.
Financial accounting, the scoreboard, it's built for outsiders. We're talking about investors who need to decide where to put their capital.
Creditors deciding if they should lend you money.
And regulatory bodies making sure everyone's playing fair. The whole goal is external transparency.
Whereas management accounting, the playbook, is strictly for insiders. Its audience is management at every single level, from the CEO down to the shift supervisor, and even the employees on the floor. It's designed to serve one single need.
To win.
To run the business better, faster, and more profitably than the company down the street. It's purely competitive.
Okay, so that audience distinction must dictate the driving force behind each system.
It absolutely does. Financial accounting is mandated by external regulation. It's all about rigid rules.
The stuff we hear about, like GAAP in the U.S. or IFRS internationally.
Exactly. And bodies like the SEC and FASB dictate the format. The source material, I love this, calls it a legal type system.
And it changes at a glacial pace, right? I mean, to change a rule in FA, you need widespread consensus, public hearings. It takes years.
It has to be slow. Its primary function is standardization across the entire market. It needs to be stable.
But the playbook, management accounting, that's the opposite. It doesn't wait for permission from anyone.
No, not from the SEC or the IASB. It's driven purely by an internal desire to get better, to find a competitive advantage.
The source says it evolves organically through best practice.
That's a perfect way to put it. If a manager figures out a better way to track efficiency on their production line, they implement it.
That afternoon.
Instantly. It's nimble, it's adaptive, and crucially, it's not mandated by law.
That's a point that gets overlooked.
Yes.
If it isn't legally required, why do companies spend millions on it?
Because it supports what our sources call the game of competition. The quest for market share, for superior profits. FA, on the other hand, supports the game of capital allocation.
Which is about making sure money flows efficiently to good companies.
Right. But FA doesn't help you win the game of running the factory floor. That's MA's job.
Makes perfect sense. One is about public trust and capital efficiency. The other is about private warfare. Here's where it gets really interesting. Once you grasp that purpose, the kind of information each system uses just diverges completely.
Dramatically. Since financial accounting is that public scoreboard, its data has to be summary level.
High level.
It's aggregated into reports like the balance sheet or the income statement. And it is strictly financial, monetary.
So it tells you the total cost of goods sold for the quarter.
But not the specific amount of waste from machine number 3 on Tuesday's night shift.
Right. But the MA playbook needs that granular detail.
Desperately. The data is highly detailed, it's proprietary, which just means it's secret. And here's the key insight you mentioned. It includes both financial data and crucial non-financial data.
Yes, this is the big one.
It is. When you look at an FA report, you see the outcome, net income. When a manager looks at an MA report, they're looking at the drivers of that income. Things like employee turnover, which predicts future training costs.
Or machine downtime, which predicts production output.
Or maybe the most important one, customer satisfaction scores.
That's the strategic secret, isn't it? The non-financial data is the proprietary edge.
Absolutely.
I mean, why would you track customer satisfaction in your internal system if GAAP doesn't care?
Because you know that low satisfaction today translates directly to lost revenue 6 months from now.
So MA is looking forward through the windshield.
And FA is recording the history in the rearview mirror, often after the damage is done.
This brings us to flexibility. Financial accounting has to be highly inflexible, standardized.
Its supreme goal is comparability through uniformity. An investor in New York has to be able to compare Apple to Microsoft, so the reports have to look identical. It creates that common reporting platform.
But if MA is built for winning, it has to be flexible. It has to be custom designed.
The supreme goal here is unique usefulness through secrecy. This is where the competitive edge is found.
But wait, if management accounting is so customized, how can managers even share best practices inside a big company across different divisions? Doesn't that lack of standardization create chaos?
That's a great question, and it hits on a common misconception. The customization applies to the metrics and the system structure that you show to the outside world.
I see.
Internally, within that one company, the MA team creates its own definitions and standards. They design a system that's perfectly optimized just for their supply chain or their specific product lines.
So the system doesn't need to be comparable to your rivals.
In fact, you don't want it to be. If your MA system is better and gives you better insights than your competitors, that difference becomes your proprietary competitive tool.
I see. Standardization within the walls, uniqueness outside the walls. That's very clever.
Now let's shift to the time dimension, because this is probably the most critical practical difference that separates the scoreboard from the playbook.
Okay.
Financial accounting is fundamentally past-oriented. It's historical. It tells you what happened last quarter or last year. It is the rearview mirror.
Looking at where you've been.
Management accounting, though, is active. It's simultaneously future-oriented for planning and real-time for controlling.
It's the engine, the thing that drives performance today.
And it operates in a continuous dynamic cycle. The source material calls it the MA cycle. Plan, then control, then evaluate.
Okay, let's dive into planning. This is where you use detailed data to set the course.
Right, and our sources clarify that planning happens on 2 horizons.
Long run and short run.
Exactly. You have long-run strategic planning, which is capital budgeting, deciding, should we build a new factory in Asia 5 years from now?
Right, picture stuff.
And then you have short-run operational budgeting. This is creating the detailed numerical plan for tomorrow's shift schedules and what materials you need to order.
So it's the difference between drawing the whole world map and then charting the specific GPS route for today's drive.
A perfect analogy. Then, once the plan is set, you move into controlling.
Steering the ship in real time.
This is where the concept of variances becomes just indispensable. A variance is simply the difference between what you budgeted, the plan, and what actually happened.
And this is where the MA system becomes an instant alert system.
Yes.
If your raw material costs were budgeted at $5 per unit, but they came in at $7, that's a variance. A manager can't wait until the end of the quarter to find out they lost money.
They need to know right now. The source describes the variance report beautifully. It calls it an exception report.
I like that.
It's like a radar gun monitoring a picture, pitch by pitch. It tells managers to ignore everything that went according to plan and focus their limited time only on the exceptions.
The things that are way out of budget or off schedule.
Exactly. If the sales team hit their targets, great, no meeting needed. But if the production line used 20% more labor than we planned, that's the exception you need to investigate immediately.
So it shifts management from just reacting to a final number at the end of the quarter.
To actively steering the individual inputs. It turns managers into investigators, focused on pinpointing inefficiency as it happens.
And finally, we have evaluating.
Right. Once the outcome is achieved, you use the data to assess the results, give feedback, and critically, you link compensation to performance.
So the accounting system itself becomes an incentive tool.
The sources really emphasize this. If you reward a sales manager based on gross revenue, they will go after volume no matter the cost.
Right.
But if you reward them based on contribution margin, they will focus only on profitable sales. The MA system is designed to align what employees do with what the company actually wants to achieve.
That adds a profound human element to what seems like just a technical numbers exercise. The numbers aren't just facts, they're guidance, they're motivation.
So if we synthesize this one final time, Management accounting is designed to allow you to run your business better. It's the engine.
And financial accounting tells you the results of how you did.
It is the outcome measure. They truly are, as the source says, different species growing in different ecosystems.
So what does this all mean for you, the learner? The relevance is immediate, and it really depends on which side of the company wall you sit. If your role is primarily internal, you're managing teams, trying to maximize efficiency, steering a product line, your focus has to be on leveraging the detailed, secret insights from MA.
You're the coach using the playbook.
Exactly.
Ugh.
You need those real-time exception reports and those custom non-financial metrics because they predict the future.
But if your role is external, if you're an investor, a banker, or a regulator, your focus is entirely different.
Right.
Your focus is on interpreting the standardized summary data from FA. You are the better reading the final box score, using those GAAP standardized reports to compare rivals and decide where capital should flow across the whole market.
You know, we have a perfect, really powerful historical example of this, of leveraging MA knowledge to drive incredible success.
The DuPont story.
Yes, tell us about that.
It's a classic. A deep understanding of these internal management accounting principles of internal optimization led them to invent the return on investment metric, ROI.
Which we all use today.
We all use it, but they invented it as an internal tool. It allowed them to connect profit margin with how well they were using their assets, all in one measurable operational way. This insight gave them a massive advantage in allocating their own resources internally.
And that helped them build an industrial empire.
It did. It just demonstrates the sheer competitive power that can be hidden inside a superior management accounting system.
That's a fantastic real-world proof point. So you use financial accounting to talk to your bankers and investors about your past results. And you use management accounting to talk to your team and guide your company toward future success. They may share the word accounting, but their function, their audience, and their impact are worlds apart.
Indeed. And maybe to leave you with a provocative thought, we spent time detailing the inclusion of non-financial data in management accounting.
Things like customer satisfaction and employee turnover.
Right. Why is this so critical? It's because these factors monitor the drivers of future financial performance, not just the historical outcomes that you see in FA. They are the leading indicators.
The warning signs.
Or the signs of great things to come. So we'd encourage you to consider, what non-financial metrics should you be tracking in your field? What predicts and drives your own success, rather than just waiting for the financial score to tell you what's already happened.